IPO stocks are on fire this year with more initial public offerings than any year since 2000 and some new stocks surging out of the gate. Shares of Shift4 Payments are up 58% since June and JFrog has boomed 66% just in the last month. But the IPO market has changed drastically since the days I worked as a venture capital analyst, and there are some things you need to know if you're gonna make money. In this video, I'll explain IPOs, show you how they work, and how to value any IPO stock. We're talking IPO investing today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube, and I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, the IPO market for stocks is hot this year. Not only are more companies issuing shares than in any year since 2000, but the first day gains are touching decade highs. 19 companies issuing stock this year have issued above the expected price target, tying that 2013 record. And there is good reason for investors to get excited about these new stocks. A single $1,000 investment in the four FANG stocks since their IPOs, that's Facebook, Apple, Netflix, and Google, would now be worth $1.2 million. Imagine that, turning $4,000 into over $1 million simply by investing in these IPOs and holding on for the ride. Now, before you go to frantically do a Google search for the upcoming IPOs, there is a dark side to this market, especially over the last couple of years. The truth is, new IPOs aren't what they used to be, and you need the facts before you invest. So in this video, I'll answer the question, what is an IPO? I'll show you how IPOs work, share the historical returns behind these, and why you need to be careful with these new investments. Stick around though, because towards the end of the video, I'm also going to show you how to value any IPO stock just to make sure you're getting the best deal possible. Now we'll get started here, but first I want to throw this out to the community. Have you ever invested in an IPO stock, and what was your best and worst experience out there? So just scroll down and share your story in the comments below. Now this first part is pretty basic, so I'll leave an index with timestamps in the video description below if you want to jump around a little bit. An IPO, or initial public offer, is when a company sells shares of stock for the first time. What usually happens is the company hires an investment bank like JP Morgan or Goldman Sachs to provide a valuation and then shop the investment around to different big money investors. The investment bank or banks underwriting the IPO will usually buy up most or all of the offered shares and then sell blocks of that through their roadshow to those institutional investors and other groups. Then when the shares start trading on that first day of the IPO, that's when Main Street investors get their first crack at it, and it's usually at a much higher price than that fixed IPO valuation. The company then receives its money from the banker, and from now on, any money that changes hands is just between investors. Despite those huge returns on a handful of IPO stocks though, like Facebook, Netflix, and Apple, research isn't as positive on the majority of IPOs. The average IPO stock loses 1.4% from its open price over the first month of trading, and is usually down 5% from the closing price on the first day. Research on IPO returns in the Journal of Finance shows an even bleaker picture, with the average IPO return flat or negative as far out as 36 months out from the issue. And the problem here is that all the value is just being sucked out of these companies when they issue shares. The problem has gotten even worse over the last year, and is really the reason why I wanted to do this video, to help you analyze and make money in that IPO market. You see, in the past, when a company issued shares, it was typically still a very small company. And the venture capital and angel investors, those early stage investors that I worked for, wanted to cash out in their IPO or an acquisition, so companies just came to the market much sooner. Now, Apple and Microsoft both issued shares at less than $1 billion market cap in the 80s, and even Netflix, as late as 2002, came to the market at a less than a $500 million company. So you had these smaller, faster growing companies that investors could then buy into and still make those double and triple digit returns. Over the last few years though, companies have been coming to market much later. For example, some of the biggest IPOs of this year, Palantir issued shares at a market value of $22 billion, and Snowflake came to the market as a $30 billion company. Now, both of these companies still have years of growth ahead of them, but even if, for example, say Snowflake were to grow to a $300 billion giant in 10 years, that's still only a 10x return for those IPO investors. That's not bad, but not even a fraction of the return for Netflix investors made, and it's only a $200 billion company. So unfortunately here, those early stage investors, the venture capital firms, the angel investors, they're all holding on for much longer for all the returns. but that doesn't mean that you still can't make money here. Now, valuing IPO stocks to make sure you get that best deal possible does take a little homework, but I guarantee you this one step will multiply your returns 3 and 10-fold. Here, I want to show you the method I use to value private companies for venture capital investors, a simple technique that you can use to value IPO investments for that higher return. Now, the technique is called public comparables, and what you're doing here is valuing the company based on values for similar stocks already trading in the market. So here you see an analysis for the popular upcoming IPO on AirBnB shares. The company just recently did a split of private shares, and the current pricing would value the booking platform at about $30 billion, or about $35 per share. First, what you need to do is research similar types of companies with public shares, and for Airbnb, that's going to be other online booking platforms like Expedia, Bookings Holdings, and TripAdvisor. Then you note the market cap of each company. That's the total value of all the shares in the market and that full year revenue. Now, since 2020 has been a horrible year for this industry, with most seeing their revenue cut in half, I decided to pull not only the 2020 revenue, but also the 2019 to give us a better look at this industry. I also found the dollar amount for gross bookings on the platforms, and this is important because you want to find at least one metric that is unique and important to that industry. For example, for social platforms, I might use the monthly users data, or to analyze a hotel company, I might find total room nights or something. Now, the idea here is that finding these industry-specific metrics and then using that in your valuation, that's going to give you a much more relevant estimate. Then you see here under valuation multiples, I took the market cap, which again is that total market value of the company, and divided by each of these, so 2019 and 2020 sales and the gross bookings number. Now, it's with these valuation multiples that we can start to estimate how much Airbnb should be worth on its IPO date based on the sales and booking numbers. And since these multiples can vary quite a bit, I like to look at the high, low, and the averages for each of these. After finding the sales and bookings numbers for Airbnb, it was just a matter of applying these multiples estimates. For example, if we use the average multiples for price to sales, we get a fair value for Airbnb somewhere around $11 billion, though the estimate is going to be much higher on that price to bookings number. Even on the use of the highest multiples, though, the company would be worth just over $20 billion on that price to sales, but as high as $44 billion on a price to bookings basis. Now, that's still going to leave you with a pretty big range for how much the company should be fairly worth on its IPO date, but it's just going to give you a good start to analyzing that stock versus its peers. In a time where IPO returns are becoming subpar and everyone is jumping into the next hot issue, it's a good way to take the hype out of the valuation and give you a better idea on value. Click on the video to the right for the penny stocks I'm watching that could change our lives. 5 companies changing the world and potentially triple-digit returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.